Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. I am really excited to have him on. I've been following his career for a long time. He became famous during the 2008 financial crisis with some amazing market calls, and his analysis is some of the best out there. He's considered one of the best contrarian thinkers. He is the Chief Investment Officer for Hayman Capital Management. Kyle Bass, thank you for joining me.
Great to be here, Jason.
Now, Kyle, before we talk about China, I want to ask you some global macro, commodities, and gold questions, top down first, before we maybe do some bottom up stuff. If the Fed tapers more and hikes rates a few times, do you think this is going to crash asset prices?
I don't. I don't think the Fed can raise rates much at all. I think when you think about these rate cycles, if what we had done was drop from 8% short-term rates to 5%, then getting them back up to 6% is not a problem, or 6.5%, because you're moving 150 bips off of 5 base. When you get to the zero lower bound, all the math becomes much more difficult. Everyone has reset their expectations to be borrowing at these levels. There's an enormous amount of balance sheet debt on the federal government, on the sovereign side. There's an enormous amount of debt on the corporate side, and a lot of it is floating rate, a lot of it short term. So I believe that moving from 0 to 1 is infinitely harder than moving from, call it 5 to 7 or 4 to 7 or 4 to 6, because it's on a percentage basis, it's so much greater from 0. And so I believe that, look, we have massive double-digit negative real rates right now, right? Inflation, I think, unchained is running, mid-teens, and rates are at 0. So everyone knows we're losing the purchasing power of our money on a daily basis. I don't believe you're going to see a major tapering and or concurrent interest rate hikes, even though we're running inflation hot. Think about this. Germany has printed about 11.7% inflation number year over year, and the 10-year Bund is still negative 10 basis points. So you just have to realize that the days of bond vigilantes are gone.
And that's financial repression and debt monetization by central banks right there, or what I call stagflate tax lie.
That's right.
And the Fed's official balance sheet in just the last week is up another $88 billion. So, I mean, it's like this taper is just a narrative. This is all spin, marketing. I call it a false narrative.
Well, look, the fact that the Fed is still buying MBS is kind of shockingly crazy to me. We all know housing prices have gone somewhat out of control in the U.S. We know that there's a lack of residential housing availability across the country. We know that the finance markets for mortgages are as robust as they've ever been, minus the crazy mortgages of the financial crisis times, call it early 2000s. But why are we still buying mortgages at the Fed when we're at when we have a problem with housing availability? It makes no sense.
There are so many distortions, Kyle, created by the Fed and central planners and all these politicians and bureaucrats. I know you lived part of the year in California. I grew up there. I lived there for almost 20 years before I moved away. And that state, they just don't allow a lot of construction and housing for more affordable housing there.
That's right. That's right. And I don't think they're going to change that anytime soon.
And another thing you brought up is corporate debt. Hasn't the total amount of corporate debt, as the Fed was lowering rates, corporations just kept borrowing more, doing more share buybacks with debt, doing more leverage buyouts? I think we're projected to get to $6 trillion in leverage buyouts, just an absolutely insane number. Hasn't the amount of corporate debt about doubled since 2008 because the Fed lowered rates?
Yeah, I mean, look, just last year alone, non-financial companies issued 1.7 trillion of bonds, 600 billion more than the previous largest issuance in American history. Just think about that number for a second. By the end of March of 2021, U.S. corporate debt stands now about 11.5 trillion.
This sounds like a global fiat currency and credit Ponzi scheme, because we're over 300 trillion in total debt if you add up all the government debt and all the corporate debt all over the globe. And yet the debt number keeps growing. You've talked about China being a rolling loan gathers no loss, but Kyle, it really sounds like the entire planet's like this. So if it's US corporate debt or European corporate debt or all these different governments now doing very similar financing where they can't allow debt deflation, they can't allow wide-scale bankruptcies. They want to restructure the debt, they want to roll it over, and they want to extend and pretend. Well,
I wouldn't call it a Ponzi scheme. I would just say that, look, we went down this road, this kind of Keynesian road of a central bank balance sheet expansion, and we followed Japan into the abyss. We followed Europe into the abyss. The U.S. is just following other nations that reached this kind of endpoint of the cycle together. I don't believe from here you're going to see a jubilee. I don't think you're going to see a crisis per se. I just believe you're going to see, you mentioned financial repression. We're going to see financial repression, for the coming decades. And you just need to figure out how to restructure your portfolio to think about that.
We're recording this interview on Thursday, November 18th. The dollar index has had a big rally lately. It's over 95. It wasn't 96, I think, yesterday. So why do you think that both the dollar index and gold prices in US dollars have been rising together lately?
Well, look, the US dollar index is essentially, again, think about this for a second. You have to separate those two questions, in my opinion. The dollar index is basically dollar versus euro, dollar versus yen, but mostly dollar euro when you break it down, right? The euro doesn't have a central taxing authority. They still don't even have a union. You still have a German army, an Italian army, and a Spanish army. You don't have a unified fighting force. You have no central taxing authority. The euro is still a big question mark. And the yen is 20 years ahead of us in a scenario where you've got major financial repression happening and artificially low rates. So the dollar index will continue to rally because we are the tallest midget in the world. It is on a relative basis, the dollar is still by far the best currency to own in the lot. The euro, the yen, the pound, all these things, they don't hold a candle to the dollar. So I've always believed you're going to see a rallying dollar index and you're going to see rallying assets with it. And I know historically that hasn't been the case, but that will be the case going forward.
Do you think it's a lot of the asset rally, especially the commodity rally, is because China is stockpiling food, energy, and now lately, especially since January, the amount of gold demand, physical gold demand in China has accelerated, especially in the last couple of months with the crypto ban, the stuff coming out of Evergrande. It seems that gold demand has really exploded out of China.
Yeah, I don't think the asset prices, like whether you're looking at steel or iron ore or food or energy, right? The demand for these things is essentially inelastic, right? And the fact that we're having major supply chain problems, we're having huge problems finding enough truck drivers and shipping and ports and this and that, demand's inelastic and growing. The ability to supply on a just-in-time basis has become a little less easy. And so I think you're going to see, and by the way, we have 40% more broad money in our system today than we had 2 years ago. So we're awash with new M2. And, I'm a monetarist at heart. So if you have 40% more money in the system, I think the price of everything's going to move up close to 40%. And again, nothing's one for one like that. But some things will go up more, some things will go up less. But I think the inflation we're seeing is just a direct result of the amount of capital in the system.
So since September 2020, a lot of the other commodities, especially food and energy and other base metals, have basically done very, very well. They've been in big bull markets. Congratulations, Lloyd Blankfein, for that call in early to mid 2020. But are you surprised that gold and silver have not actually started to rally too much during that time period? And do you expect that there will be a catch-up rally in the near future?
So I think that the reason gold hasn't moved is because the world created $2.5 trillion worth of private crypto. So I just think a lot of the people looking to hedge against inflation and things like that move to other assets.
So you think then that a lot of the gold demand was taken away, people sold their gold and then went into crypto, or fund managers? We just had that story in the last 2 weeks where Jefferies, I think, closed down their gold fund, $440 million, and moved it into a crypto fund at the top of the Bitcoin market.
Is that right? I actually didn't know that.
Yeah, I put that out on my Twitter. I said that's probably a contrarian indicator. That's right around when gold bottomed, when it was still below 1,800. And I was like, this reminds me a lot of the late 1990s when I studied the gold market, around when the Bank of England sold, the Bank of Canada sold a lot of their physical gold. And that was pretty much that was called Brown's bottom. That was pretty much the contrarian indicator bottom of the market, where a Wall Street bank was selling a commodity that hadn't done anything and was chasing Bitcoin after it was at an all-time high.
Yeah. So look, I don't know what the total market cap of all crypto is today. I think it's about $2.5 trillion. But I think private crypto is going to have a tough go of it over the coming years. And you asked if we're going to see a resurgence or a catch up in gold and silver. I think if crypto ends up doing poorly over the next couple of years, I think you'll see more of the buyers come back to things like gold, and I believe things like rural land will do really well going forward. So anyway, things like that are going to happen.
Well, regular people in China, because Chinese Communist Party members the elites can do whatever they want there, but regular people in China can't buy crypto anymore. So then you have all these problems with Evergrande. You have Chinese technology stocks getting penalized. So that's actually really, really good in China for physical gold demand and physical silver demand. Physical gold demand, I'm not sure if you saw the latest numbers, it's up 48% in China in just the last 12 months. It's exploding higher. And there's videos of long lines all over China to buy gold.
Yeah. So I agree with you, and just believe that you're going to see people moving and rotating into other assets as private crypto. So again, separate my comments between smart contracts, protocols, NFTs. I think all of those things are here to stay. I think the blockchain is going to be amazing over the next 10 years. I think pure private crypto is going to have a rough go.
Do you think governments are going to try to tax it more because they're starting to scale up and roll out their government cryptos, their central bank digital currencies?
Yeah. Today, private crypto is taxed as a collectible, like a piece of art. If they were simply to reclassify it as either private crypto or a currency, which they've heretofore been unwilling to do, but I think you're going to see this. If they classify it as a currency, then it doesn't matter if you have sold it by the end of the year. It's mark-to-market gains and losses every day, and taxable gains and losses each year. So imagine if all of a sudden the entire crypto market had a mark-to-market tax gain on December 31st, what that means for the market.
That doesn't sound very pleasant. Sounds right. Sounds good if you're the U.S. Treasury, not good if you're a crypto trader.
Yeah. Yep.
Do you see stagflation then continuing going forward for 12 to 24 months? Or do you think at some point that higher and higher inflation, stagflation, and taxes is just going to cripple the consumer, cripple discretionary income then?
Yeah, I think, what's going on with stagflation right now is really to the detriment. The interesting thing is to the detriment of the poor, right? And the middle class. The rich can afford to pay a little bit more for gasoline and food. It doesn't really impact their lives. But the poor, who spend every dollar they have on rent, gas, and food, they're getting destroyed by this financial repression. And the middle class has an inability to move higher on the ladder because the asset prices have so far outstripped wage moves, wage gains. So it's really, really interesting. It's interesting to me.
I agree. And if politicians and bureaucrats and labor unions try to force wages higher, I did a video on this for my YouTube channel. There's two sides to this. So I am sympathetic that people can go and ask for higher wages, but if you're a small business owner and the government tries to force higher wages on you and you can't afford it, your profit margins are thin, say at a restaurant or a low profit margin business, it's going to bankrupt a lot of small businesses too. So there's two sides to this that could potentially, a lot of businesses could be destroyed with these wage hikes.
Yeah. Yeah.
So now I want to transition to China questions. How much of China's 50 trillion in credit, that's a number you've talked about publicly, do you think is tied to high real estate prices? So in other words, do you think that these high real estate prices all over China in all the cities are the foundation for their credit market, their shadow banking system, and their derivatives market?
Yeah, I think it represents a little over a third of that market, which of course is statistically significant and important. The real estate market in general represents 30% of China's GDP. And so, what people don't really recognize, in my opinion, yet is why Xi had to do this. And again, it's because you see the fertility rate of the average Chinese female now is 1.2 births per woman. And just to sustain a population, that number has to be 2.1. So they are way low on their fertility rate. And what that means is many of the Chinese men, of course, given the fact that now housing in tier 1 cities costs over 27 times their average income, so way outside of anyone's ability to afford basic dwellings and housing, many of the men are living with their parents in their basement. And so the men aren't marrying, the men aren't having children, they're living with their parents in their basement. And fertility rates are collapsing in China. So this is irrespective of the one-child policy. This is a real problem. And so what Xi's doing, it's not just reining in the Chinese billionaires and making them pay homage to the leader. What he's doing is he's got to restructure the market, and he's got to bring real estate prices way down, and they've got to stay down. And he will be successful in doing so. This is not going to be we restructure a few companies and prices bounce and we're off to the races. That is not going to happen in China. So I think you're seeing a really interesting crackdown. I think it's going, Goldman has the Chinese growth number for 2022 at 0% because they have a third of their economy now, declining pretty rapidly. So it's interesting to think about what's really happening behind the scenes and not just think that you can trade things because you're on a chart and things revert to the mean and they have corrections and move higher. I don't think you're going to see that here.
But if real estate prices do go down, and I've spoken to real estate investors in mainland China, I have some of my own sources, and I've heard from them, and they own a lot of properties in tier 2, tier 3, tier 4. And I even heard a story in Shenzhen in tier 1 that some properties were down 25%, but that number is widespread in tier 2, tier 3, tier 4 cities the last 4 to 6 months. If you do have much lower real estate prices, isn't a lot of this debt that was used to buy the real estate, isn't this debt going to default? Or is the Chinese government and the banking system there, the People's Bank of China, just going to print the money to bail out all these entities, roll over the loans, and try to prop up real estate prices then?
Yeah. So I don't think they'll prop up real estate prices. I think they will create holes in balance sheets of a lot of the banks, right? You have the 4 SOE banks, you have 12 big joint stock banks, and then you have, 10,000 or so local banks. There's going to be huge holes in the Chinese banking system. And I think you're going to see wealth management products fail. You've already seen a couple of them not pay. And that in itself is a problem for the banking system. But I do believe that the regulators will fill those holes on bank balance sheets. They'll probably let some banks fail, but none of the joint stock banks or SOE banks will fail. And but I do think it will. All this means is the globe's going to grow a little slower. China's actually going to have a no growth to negative growth for the next couple of years.
So you expect a Japanification type scenario out of China, then, similar to what happened during Japan's bust in the late 80s, early 90s? They're trying for that.
They're not trying for it. I mean, they'd rather have a controlled emergency landing than a crash landing, and that's what they're aiming for. You have to realize something else, though. The Chinese have only been at this, call it capital markets business, for 20 years. we have been at the capital markets business for a lot longer than that. And think about where we got to in 2007 and 8, right? So they have more plates spinning than they know what to do with. And I think having a controlled emergency landing is going to be tough. But I actually think internally they're going to make sure that they don't have, bank runs and bank panics. On my wall next to my computer here, I have a Henry Cartier-Bresson photograph that was taken in Shanghai in 1948, when the Communist Party, basically when the turbulent transition from the Kuomintang to the communist rule. If you remember, there were huge bank runs there. And I don't know if you've seen this Cartier-Bresson, but it's a number of Chinese people just crushed together in line because the government decided they were going to distribute 40 grams of gold per person for their deposits because their deposits got wiped out. And thousands of people were crushed in this line. 10 people died waiting in line because they got crushed between other people. So anyway, this is on my wall. I see it every day.
That's crazy. I mean, I've read about bank runs before in other countries, in the US and other countries, never heard about that one in China. Although I have seen some videos the last couple of years when the Chinese banking system, a crisis started to explode in 2019 with Bank of Jinzhou and Baoshan Bank and some of the others. And there were long lines with bank runs there too. But the Chinese government, in a fiat currency system, they can basically just print as much as they want. And you've been talking about that for years.
That's right. I mean, they've printed more money than we have, which is saying something. And that tree can fall in the Chinese woods, and the Chinese government can plug holes in their banks. They will abandon moral hazard. They'll keep their banking system together. But will a bunch of wealthy Chinese people lose a lot of money? Absolutely. Will a bunch of upper middle class Chinese people lose a lot of money that were speculating in these wealth management products? Yeah, they're going to get killed. So this is just going to be a reset and redistribution of wealth in China.
And I think that's why so many Chinese people are buying gold, also because of the crypto ban.
Yep, that's right. That's right.
So I've been paying attention to HSBC Bank stock since the Evergrande news. And HSBC Bank stock, shockingly, has been rallying. I think it rallied over the last couple months from about $24 a share up to around $30 a share. They just announced a large share buyback. I think a dividend increase too. How much exposure do you really think that HSBC Bank has to the Chinese real estate markets, though? Because they're telling the public that they have very, very little. But I went back and I looked through old investors' presentations from 2015, 2016, and they're bragging about opening up all these branches in the Pearl River Delta for all these businesses that are all connected to real estate. But I couldn't find any actual numbers on how big their banking business is connected to that.
Yeah. Look, I don't know how much real estate, Chinese real estate and associated loans are on their balance sheet, but my guess would be it's pretty heavy. I would imagine if it's representative of Chinese assets, Chinese GDP, it could be up to a third of their balance sheet, which would be huge, right? The bigger problem for HSBC that people need to focus on is, you remember back in 2014, they signed a consent decree with the U.S. Justice Department because it was found that HSBC was running the entire money laundering operation for a couple of the big Mexican drug cartels. Now, they paid a multi-billion-dollar fine, but nobody received criminal charges. No one went to jail, which is kind of hard for me to believe. But in that consent decree, they promised the U.S. Justice Department that if they ever found themselves internally to have been money laundering somewhere else or for someone else or breaking any U.S. laws, they were compelled to self-report what they found. It turns out that they hired someone to do an analysis of their banking system to understand if they were acting as a conduit for terrorism finance. And it turns out that they were laundering a lot of the money for Hezbollah. And instead of notifying the Justice Department, you can go look back at this. They sold their entire South American branch network in one sale to Bradesco for like $5.5 billion. And then 6 months later, they closed their Beirut, Lebanon branch, and they put out a press release saying they're closing it because it was just unprofitable, which was complete bullshit. So I think HSBC's got a real problem. I think they've got a real problem with the consent decree with the U.S. Justice Department from back then. And you've probably seen, Jason, recently that the U.S. was able to extradite Maduro's number 2 guy from Europe, from Belgium, I think it was. And you probably saw it leaked that Morgan Stanley's being looked in for their participation in financing Maduro or helping run his network. You're going to see, I'll predict something here, you're going to see the largest money laundering indictments that you've ever seen in the history of banking and financial markets. And I think HSBC is going to feature prominently in those indictments for moving money around from Maduro and Venezuela against U.S. Sanctions. So I think HSBC, for some reason, always shows up at the top of the bad guy list. And at some point in time, the U.S. is going to revoke their license to operate here.
You also mentioned this in the last couple of years on a mainstream interview on Yahoo Finance, and the journalists there didn't ask you, they didn't follow up. I think they just ignored what you said. I've talked to you about this as well. And I think you also mentioned this on Real Vision, that HSBC has a 500 billion loan out to the People's Bank of China, and then the Bank of England found out about it, and the People's Bank of China and other Chinese banks haven't paid anything back on it yet. Yeah,
look, I think HSBC is the root of all evil in Asia. And I don't know anyone there, so I don't have a particular axe to grind. I don't have any positions in HSBC at all. But I think that they're, and if you remember, HSBC was the very first bank to immediately jump out when China abrogated its filed agreement with the UN, the Sino-British Joint Declaration of 1984, when China took over Hong Kong and basically stomped out all human rights, basic human rights and rule of law. HSBC was the first bank to back the Communist Party's seizing of the assets of Jimmy Lai and Apple Daily and other pro-democracy protesters. Their assets were seized by the government. And so HSBC can't have its cake and eat it too. They can't do business in the West and then back the Communist Party and their lawlessness. So I think they're going to be forced to choose soon.
Yeah, I was just shocked about HSBC's earnings, but I guess they can do some financial engineering for the short term. I don't know if I've spoken with a lot of people. I don't know if anyone knows the real number on their Chinese real estate exposure. They've done a really good job hiding it.
Yeah.
I have one final question here, Kyle, before I let you go. It's on the energy and electricity crisis in China. How bad do you think the energy and electricity crisis in China is? And do you think it's going to cause stagflation then in China for 12 to 18 months as they continue to stockpile energy all over the globe?
When I think about, again, energy demand is inelastic. It tracks GDP. But when you think about hydrocarbon demand is going to grow globally, I think, going in all the way into 2037 to 2040. And we all believe that you can just flip a switch and go to alternative energy production and just walk away from hydrocarbons. I think that you're going to see much, much higher hydrocarbon pricing as we get into the reopening of the world in 2022. So that's going to be a real problem for China, right? You already see food prices up 50% in about 9 months. You've already seen oil and gas prices at mostly all-time highs on some LNG cargoes. Some LNG cargoes went $32 an M. And I think you haven't even seen it get cold yet this winter. So China's real challenge is going to be this inelastic demand that's going to propel prices much higher and cause internal inflation in such a major way in China. And it's hard to fight that because, as you know, they're short energy and short food. So they need to go out and acquire these things. So it's going to be a real problem for them over the next year or two.
And I don't think the narrative for many, many decades, the last couple decades, is that China has been able to export deflation with their manufacturing. I don't think that's true anymore because wages are up so much and the other input costs, especially energy and electricity. I've been watching some videos on YouTube interviewing Chinese business owners of factories talk about how much their energy costs are up. But this Chinese inflation data that comes out from the government, I mean, it's high numbers. It's a record high. I think it's like 16% increase in energy. That's not the real number. That's not what the business owners who run the factories in China are saying on the interviews. They're saying their energy costs are up like 10x, not 16%.
Yep, I think you're right. Jason, I appreciate the conversation today. Thanks for taking the time.
Great. And I'll put a link to your Twitter if people want to follow you on your Twitter. But I really appreciate speaking. Hopefully you'll want to come back on again and have a nice chat here about global macro in China again soon.
Sure. I appreciate it. And good luck with your with kind of your issues over the holiday season.
Thanks, Kyle.
Take care.